Welcome to Loop TV. I'm your host, Gene Munster, along with academia today. I think this is the first time we've had someone from the ivory tower visit Loop TV. Welcome, Professor Johnston. He is a 30-year, 3-0, that is longer than most of you have been alive, professor at St. John's University. For those of you who are not familiar with St. John's, it is a small school in just outside of Minneapolis, and it's got a great reputation. And thank you, Professor Johnston, for joining us. A good day to join us. I feel like this, I know you're a professor of economics, but I feel like your role today is more like a shrink and helping me feel better here. I guess, down on that easy chair here, thinking about rates and the markets and frontier tech stocks in
Hmm.
particular really getting throttled here.
They are.
Of course, Chairman Powell had comments today in the Wall Street Journal. From what you know of what he said, was there one or two takeaways?
Yeah, there's one big takeaway and then one smaller one. The big takeaway is the Federal Reserve is publicly committed to keeping interest rates low. And in particular, they're going to keep them low until they see unemployment flattening out. And that's a really big change. The way the Fed usually operated over the last 40 years or so was as soon as they saw unemployment getting relatively low, they would start raising interest rates. Now they're going to let unemployment keep dropping and keep dropping and keep dropping until it kind of bottoms out. Then they'll think about raising interest rates. So one person I saw commented that this is kind of a back to the future strategy. They're going back to the way they did things in the early 1960s.
This is a little bit out of the ordinary to be essentially this insistent that rates are not going anywhere. And I kind of sense like the sub thread here is trust us, trust us, trust us. And
Yes.
the market's not trusting us.
Well, the markets, they're not trusting them. And it's what I think that this is the other takeaway is that the Federal Reserve has to convince the markets that they really mean it. And part of what they're doing by Chair Powell giving an interview in the Wall Street Journal, President of San Francisco Fed giving a speech on this same thing today, the other Fed presidents giving speeches on this all around the same time is like, believe us. No, really, believe us. We are really changing our perception. And,
So
there's a proof is in the pudding ultimately, right?
proof's in the pudding. In the near term, there's the perception around the market too. I just had this vision of the Fed dispatching all of its voices to calm people. In fact, what we're seeing, even in the efforts to calm people, a disorderly rise in interest rates. It just seems to be that there's a perception that's hardening around the view that the Fed is going to be unable to deliver low rates, and this ultimately could become a self-fulfilling prophecy. And I wonder what would be your perspective?
I think there is always that danger. I think a lot of what's happening, and I don't know whether you agree with this or not, but my view is that, especially on the long end, that is longer term interest rates, they believe that the Fed actually will be successful in raising inflation because one of the problems has been is they can't even hit their 2% inflation target. And I think, at least in the government bond market, the investors are saying, we think they might deliver 2.5, maybe even 3% inflation. And so we need to bump those rates up just to include that inflation premium.
Mention the I word here because at that point when Powell had mentioned that to expect some temporary inflation were the language that he used, that the markets really got spooked about that. And what can you enlighten me? What
Sure.
is temporary inflation?
So part of the problem with measuring inflation is it's got all kinds of noise in it. So for example, maybe fuel prices are spiking up and something else is going down. And so you're going to get these kind of wild movements. And especially in the midst of a pandemic like this, when you've got supply chain problems, so that there are shortages that are causing prices to go up here. And in other markets, you've got stuff rotting, so the prices are falling. It's really not clear which way inflation is going to go, but the most likely is you're probably going to see a big increase in a lot of prices to deal with these shortages. And so inflation is going to go up for maybe 6 months, a year, or something like that. But then it's going to come back down again.
Gotcha.
It's
And
not
so
that
would shortages be shortages of It's not homes, right? That's not part of
No.
the
So,
basket.
for example, one that I think's going to impact a lot of manufacturing is the ability to get silicon chips of all kinds. There seems to be only two places that fabricate silicon wafers right now for integrated circuits, and both of those places are in East Asia, and both of them are having trouble fulfilling orders because of COVID.
Got it. Makes sense. And thank you for educating me on that. When you think about inflation more broadly, and you think about the government's definition of that, and do you generally trust what the government says when it talks about inflation?
I do. I do. The data are are some of the most reliable that there are out there. The problem is that you need to pick the right gauge, and there are at least three different gauges you can pick. They all will give you roughly the same view, but some of them will show more inflation than the others. So those are the consumer price index, which probably is the one that shows the highest rate of inflation. Then the GDP deflator, which is basically a number that shows how much prices are going for all the goods and services in the economy. And then there's one called the PCE, or personal consumption expenditure deflator. All you need to know is it focuses in on consumer goods. So you see what's going on with consumer purchases. And they all pretty much show the same trends. But back to your other question about a temporary burst of inflation, the CPI will show a way bigger burst than the other measures. And so
The fact
it's
that when this burst happens,
mhm.
what's your take on, or what, I'll ask you, what's your take on the market's perception of that? Will they say Chairman Powell told us this was coming, or will they say something bigger is coming? These aren't just simply rain clouds; these are more sinister
Yeah,
clouds.
I I actually don't know. I think that is the question, is how are markets going to react to that? Because from an economist's point of view, the market, people in the market should be looking at all the information available and believe, and if they believe what the Fed says, then they should just kind of slough it off. They shouldn't build that into long-term rates. On the other hand, if they don't believe them, it will show up not only in the shorter and medium term rates, but in the long-term rates too.
The end of the time, should we believe the Fed?
Well, I actually think you should. I think that the evidence for the last 40 plus years has been pretty solid that when they say they're going to do something, they do it. And the two examples I have of that are, number one, in 1980, when the Federal Reserve said, we're going to break the back of inflation, they did it. It cost Jimmy Carter the presidency, among other things, but that, and put lots of home builders out of business. And but they stuck to it. They kept interest rates up near 20% for almost 2 years. The other time is the financial crisis of
Let me
2008.
stop and go back.
Oh,
That was 20%, 20, correct?
2-0. My
Okay.
first credit card had a 25% interest rate on it.
I'm sure, but that is quite remarkable to show how far down we've come.
And that's what I think is part of it, is the Fed has shown their credibility. They have shown that they're going to do whatever it takes. And they did that in the financial crisis too. They said, we're going to do whatever it takes to save the financial system. And even though in retrospect, some of the things they did were probably not the right things, it was not a matter of inaction. It was a matter of
I
getting in there and
sense
doing what they needed to do.
there was a lot of that kind of language today too. And just to recap, we've had Powell say over the last few months, and not even thinking about raising the rates, and reiterating that a couple weeks ago, reiterating it today. And the bond markets are taking a little bit of different direction. And correct me here, maybe can you give everyone a crash course in quantitative easement?
Quantitative easing, yes. So suppose interest rates for 10, 20, 30-year bonds starts to go up. Well, what the Federal
We're
Reserve,
seeing right now,
exactly.
not listening to the Fed.
Right. So if the Fed thinks that that's getting too high, they could actually go out into the market and start either buying or selling those bonds on their own account in order to move bond prices and therefore interest rates wherever they want them. That's what quantitative easing is all about.
When you describe the Fed and they're committed to doing things, I think about their ability to move heaven and earth. And it would seem that quantitative easement is one way that they could do that in the future if there continues to be this this gap between what the Fed's saying and what the bond markets are saying. Do you see that as a lever that they potentially could pull in the next 1 year?
I think it's possible, but not likely. It's the break glass in case of fire option. If the markets really started to just keep pushing those interest rates up and the Fed wants to show we're going to keep our promise, that might be one way to show they're going to keep their promise.
So let's just say it's unlikely, but let's say something like that does happen, QE happens, and what's the market's reaction going to be? A sense of relief that the Fed's stepping in, or is there going to be a sense of discomfort for whatever reason?
I think it's the latter. I think it's discomfort because then you've got a situation where um, the Fed's credibility is being called into question. And I think that's where you start having problems, because if you've got at least a significant segment of financial markets not believing what the Fed is going to do, despite them saying it, despite them perhaps even intervening with quantitative easing, then you've got to wonder how much control does the Fed have. But I guess I see that as a relatively remote possibility.
And then if that's the kind of the far out remote possibility, and they do in fact want to move heaven and earth, what more can they do?
Well, I mean that's that is in a sense up to Congress, because the Fed has a pretty broad mandate that Congress has given them. So they could do everything from start offering to buy any securities out there. If they really had a terrible situation, they could open up what they call a facility and say, we will buy shares in money market mutual funds. We will buy corporate bonds. We will buy mortgage backed securities.
And
You know,
what effect would that have on those instruments?
well, it usually has the effect of lowering their interest rates and raising their prices. But again, that's not very likely, but they used those tools both in 2008 and earlier in 2020.
Every hot real estate market right now, people trying to buy homes, there's not a lot of inventory. Is the average person going to be spending more for a 30-year mortgage because of everything that's going on right now? I suspect the answer is clearly yes.
Clearly, yes, for the basic supply and demand reasons like that, plus the long end rates going up right now.
Right. So even if you're not heavily invested in the market, if you're thinking about investing in a home, this impacts us all.
Definitely.
I know you're a student of the current and the past, but if you're going to kind of fast forward a year from now, what's your prediction? What are we talking about regarding this topic?
Well, I think we're going to see long rates are going to be higher than they are now. I'm thinking they might go up into the 3 and 4% on government bonds, but I don't think that's going to be permanent. I think they're going to go up. And in part because of this temporary inflation, they're going to go up, but then I think they're going to come back down again. It'll depend a lot on how fast the economy grows, because I think one of the things that's going to determine the level of interest rates is whether there's a lot of pent up demand for goods and services. If we get a really strong recovery, say like 4% GDP growth in real terms, then I wouldn't be surprised if interest rates cracked 4 at the long end.
So
And
that's
that's on
so
government bonds. That's on government bonds.
so for those who believe that interest rates go up, the equity markets go down, that's somewhat cautionary of a position you have, at least over the next year.
Exactly. Yep.
Okay. I can tell you this, Professor Johnson, I studied really hard in econ, and I thought I learned a lot over, I think I took a introductory to econ and probably a second one. I don't know what you know better than I would, what it would be, but it is, and by the way, you were not my professor. I was in
Clicking.
college
I don't remember.
25 years ago. You could have caught me, but for those listening, no, we did not cross paths in the classroom. And I can say I've learned over the last 15 minutes, I think, as much as I did in a semester, possibly a year back
Oh,
when I was in school,
oh,
college in
thank
the
you.
mid 90s. So I really appreciate it. Most clear. I hope you're wrong.
I do
I
too.
fear that you are right. And I appreciate you giving us a heads up of where you think the world's going. On behalf of Professor Johnston, the University of St. John's, and Gene Munster and Loop TV, bye for now.